Every empire claims its currency is secure. Every government asserts that its promises will hold forever. But history repeatedly proves them wrong. From Rome to France, from the Confederacy to modern Lebanon, people have woken up one morning to find their savings worthless, their salaries meaningless, and their futures stolen. Collapse is not a rarity, it is the rule. The real question is not if financial systems will collapse, but how you will protect yourself when they do. The illusion of permanence is the most dangerous financial mistake one can make. We look at our bank balances or national currencies and think these are solid like rock. But money is not rock. Money is built on trust, and trust can vanish overnight. This is why history is both ruthless and instructive. Every collapse leaves behind lessons, patterns, and warnings, showing what truly protected wealth and what vanished in an instant. If you look carefully throughout history, the survivors were not the most trusting, but the first to become skeptical. Let's consider the Byzantine Empire. It is often remembered as the eastern half of Rome, surviving for 1,000 years after the fall of the Western Roman Empire. At the heart of its economy was a gold coin called the solidus. It was so reliable that for centuries, merchants across Europe, the Middle East, and Asia accepted it without question. It functioned as an almost global reserve currency in the medieval world. But the interesting part, which loyal followers will appreciate, is this. You would expect them to have learned from the Roman silver denarius debacle. Emperors had debased that coin to the point where it was almost copper with a thin silver plating. Yet centuries later, the Byzantines made the same mistake, this time with gold. They began reducing the purity of the coin, mixing in cheaper metals. At first no one noticed, but eventually trust was broken. The currency that once sustained the entire Mediterranean trade became merely a political story. Debasement destroyed the money's credibility, and with it the Byzantine economy lost the stability it once possessed. So, what survived? Not paper promises or government decrees. The merchants who held real gold or assets beyond the empire's reach preserved their wealth. Everyone else's money became worthless. Here is the first lesson. Governments cannot resist the temptation to debase currency. And when they do, real value inevitably moves away from fake paper towards tangible assets. But not every collapse is caused by governments debasing money. Sometimes a completely unexpected shock occurs. Like the Black Death that struck Europe in the 14th century, 1347 to 1351. Half of Europe's population died. Cities emptied, villages vanished, and trade routes collapsed. But the economic story of the plague is not just one of disaster. With half the population gone, the remaining workers became more valuable. Wages rose, and food and land shifted from scarcity to abundance. Those who had cash, goods, or labor power gained unexpected bargaining leverage. Land and houses that were once expensive suddenly became cheap. In short, the survivors had a buyer's market. Comparing this to the modern world, the COVID pandemic is a similar example. Supply chains broke down. Governments printed trillions to keep the economy afloat. And once again, those with liquidity accumulated assets. Millions living on salaries were left behind. Pandemics have always done the same thing throughout history. They redistribute wealth. The prepared win, the unprepared lose. The banking collapse in Florence teaches a similar lesson. In the 1340s, Florence was the financial capital of Europe. Powerful banking families like the Bardi and Peruzzi had lent huge sums to kings. When the king defaulted, the banks collapsed. The people were ruined, trade halted, and Florence was plunged into chaos. The lesson. The too big to fail myth is a lie. Size does not mean safety. Institutions exist for profit, not to protect you. And when they collapse, your savings disappear with them. These examples are not limited to Florence. Lehman Brothers in 2008 and Lebanese banks in 2019 repeated the same story. Consider the American Civil War. Both the Union and the Confederacy printed money to finance a war on that scale. The North's greenbacks and the South's graybacks quickly lost value. Inflation spiraled out of control, salaries could buy almost nothing. In the South, currencies that once worked became worthless. Who survived in that environment? Not those who trusted paper money, but those who possessed real assets like gold, land, and food. The French Revolution provides a similar case. In the 1790s, revolutionaries overthrew the monarchy and nationalized church properties. A new paper currency, the assignat, was issued, theoretically backed by the value of these assets. But with each new print run, the government debased the money. Prices skyrocketed, wages couldn't keep up, and the assignat became worthless. In Paris, people refused to buy bread with paper money. They demanded silver or goods. Who were the winners? Not those holding patriotic paper, but those who possessed non-printable assets like food, gold, or property. The Asian crisis starting in 1997 is another such example. Thailand's currency was pegged to the West, but the peg broke. Those who had borrowed in dollars suddenly couldn't repay. A domino effect followed, crashing the economies of Indonesia, Malaysia, and South Korea. Most people lost their wealth, but those who held dollars or assets overseas came out ahead. The lesson: borrowing in someone else's currency is a death trap during a crisis. The debtor fails, the creditor survives. And a contemporary example, Lebanon, 2019 to 2021. Banks locked their doors. When citizens woke up one morning unable to access their accounts, they found they had lost 90% of their money. The middle class, retirees, doctors, engineers, everyone who believed the system was reliable, was impoverished. Who profited? Those with assets abroad, those who owned gold or property, or those who didn't keep their money in banks. Everyone else was trapped. History shows that blind trust in currency and institutions always leads to loss. The survivors are those with real assets, liquidity, or the ability to produce. Collapse can be a catastrophe, but it can also create opportunity. After the Black Death, peasants became landowners. After 2008, those with cash bought homes. History keeps teaching us the same lesson. Protection is not just about defense, but also about seeing the opportunity. Wealth is not measured only by what you own. Skill and production capacity are also keys to survival. The baker who keeps baking bread, the artisan who repairs tools, the farmer who continues farming, the merchant who keeps trading, these people thrive during crises. Money may lose value, but production always holds worth. Real protection is not blind trust in government or banks, but real assets, skills, and awareness. History has proven time and again. During crises, wealth transfers from the trusting majority to the prepared minority. The question to ask is simple. In a collapsing system, will you cling to empty promises or will you hold real value? History may not repeat itself exactly, but ignoring it always leads to loss. Don't forget to like the video and follow me for more.